Good morning. Today we'll discuss about capital structure analysis. Capital structure analysis is also called as long-term financial analysis. Long-term financial analysis mean when a bank gives loan to a company, a financial institution or banks, they see the long-term financial position of a company, whether the company is in a position to pay installments on time or not, how the company's assets are acquired, whether they're acquired from external funding or owner's money. Okay, so in this analysis, we purely depend on balance sheet items, wherein how the capital is used to purchase total assets. Capital is used to purchase total assets. The issue is how the total assets are funded, whether they are funded from owner's money alone, that is equity capital, or debt capital alone. It is not possible to purchase entire assets with debt capital, because without having our own money, we cannot borrow money from outside. Okay, they don't believe us. Like, if you don't invest in your company, how do you ask us to invest in your company? Therefore, you will have a structure. Capital structure means the proportions of both debt and equity. A debt capital consists of current liabilities, which are of spontaneous, means you don't need an agreement, you don't need any terms and conditions like accounts payable, accrued expenses, incomes received in advance, bank overdraft, etc., or current liabilities, wherein you don't have any burden of interest other than short-term loans and bank overdraft. But long-term liabilities like bonds, debentures, bank loans, long-term loans, etc., have lots of terms and conditions, and also a fixed interest rate. Fixed interest need to be paid. Therefore, we see that how this combination of amounts are used in the purchase of assets, and how the equity capital, which consists of preference share capital and common share capital, are issued or used in the purchase of assets. What is the portion of debt capital? What is the portion of equity capital which is invested in purchasing the assets? So total assets equals to total capital, which includes debt capital and equity capital. But what are the proportions of these two invested in purchasing the assets? That is an issue. This is what we are going to study. And this study is called as capital structure analysis or solvency analysis or long-term financial analysis. Capital structure analysis begins with a begins with long-term long-term asset debt to asset ratio. And before that, let's have a look at our balance sheet. Our balance sheet consists of current assets, okay, and non-current assets. Current assets and non-current assets. This is long-term assets, okay, long-term assets, not long-term liabilities. Current assets and fixed assets. We have total assets. These total assets are funded from here, 171,900. But the question is, how much of this 171,900 is funded here, and how much of this equity is used in this? What are the proportions of this and this? You see here 141,950, 149,950 and 21,950 both are used in the purchase of these assets. Okay, so this is what we are going to study here. Capital structure. Capital structure consists of the current assets, long-term assets, how these assets are purchased, whether using debt portion higher or equity portion higher, which we call it as solvency analysis. So in the solvency analysis, very first ratio which we are going to calculate is debt to total asset ratio. What is that? Debt to total asset ratio. Debt to total asset ratio. In these ratios, you can construct a formula very easily. Whenever I use 2, TO2, just divide. Okay, debt divided by total assets. And both are balance sheet items. Do not do any average. Do not calculate any average. Debt divided by total assets. So, debt to total asset ratio. Here, debt to total asset ratio. For example, if you have a debt to total asset ratio of zero point 0.4 means if you have a 40 million of debt capital, which includes current liability and long-term liability, we have total assets of 100 million. Debt to total asset ratio means out of 100 million total assets, external parties money invested in purchasing the assets is 40 million and owner's money is 60 million. So the business is strong. Why? Because major portion of the assets are purchased from the owner's money, that is preference shareholders money and common shareholders money. Therefore, the debt portion will not have much strength on the assets. Otherwise, if a company's assets are higher on the debt asset ratio side, company will face an issue of leverage. Means we should pay a fixed interest and also we should we should listen to their covenants. Covenants means terms and conditions because this portion is higher. But here it is 40 is to 60. It is very healthy ratio. Means 60% of assets are purchased with our own asset amounts and 40% is from the others assets. And the formula is total debt divided by total assets. When I say total debt divided by total asset, it means total debt, current liability plus long-term liability divided by current asset plus fixed asset. Total debt to total asset ratio means total debt, current liability plus long-term liability divided by total assets, current asset plus fixed asset. So here this ratio should be always less than 40%. Why? Because 40% of the total assets are acquired by borrowing money and the remaining 60% owner's money is used in purchasing the assets. Total debt to total capital ratio will also help you. Total debt to total capital means here total debt, current liability plus long-term liability. Total liabilities means again current liability plus total, long-term liability plus total equity. Means the liability side and equity side total. Means what is the total liabilities to total liabilities and equity. Say for example, we have current liability, long-term liability, current liability of 2 million, long-term liability of 3 million, and equity of say 15 million. The total is 15 plus 3 plus 2, 20 million. Means what we are going to calculate is what is the total debt capital over this total amount. That means 5 divided by 20. Total debt to total capital ratio. Total debt to debt. Total debt to total capital ratio. Okay, so what portion of this amount is there in the total capital, which includes debt capital and equity capital? Then the next ratio will be debt to equity ratio, which you need to concentrate from examination point of view. What it thinks of is, here in my calculation, I mentioned that long-term debt is 2 million, current liability is 2 million, long-term liability is 3 million, and equity, preference shareholders and common shareholders money is 15 million. Here we are studying the relationship between this amount and this amount, debt to equity ratio. So in terms of this, how much money we have here? Okay, so this amount is to be taken into consideration here. Debt to equity ratio. Debt to equity ratio. Okay, mostly the ratio should be around 40% of this again. This should be the 40% of this 15. Lesser is always good. Lesser is always good. Why? Because you will have freedom in making the decisions. So total debt divided by total equity. Total debt, again, whenever I use total debt, it means that current liabilities plus long term liabilities, and shareholders equity. Total equity means here super 6. The 6 items: preference shareholders, paid in excess of par, common share capital paid in excess of par, retained earnings, and minus treasury stock. So this is what we call it as super 6, right? So total liabilities divided by total equity, that is debt to equity ratio. Then long term debt to equity ratio. When we think of this debt to equity ratio, total debts, total liabilities, as I told you, that current liability and long term liability, we don't have any issue with current liability. Why? Because the major portion of current liability is made up of accounts payable. Accounts payable is a spontaneous credit given by the suppliers. So you don't have any terms, conditions, hard rules, etc. etc. But in the case of long term loans, you meet lots of standards to get the loan. You have to meet lots of standards to issue bonds. To raise long term loan, you should be eligible. But to raise a current liability, just you maintain a good relationship with the suppliers by paying on time. That's more than enough. That's the reason why current liability is called as a spontaneous credit given by the suppliers. So let us give importance to long-term liability in terms of equity. Then the ratio will become long-term liability to equity. That is long-term debt to equity ratio. Long-term debt to equity ratio should be again less than 1. It should be less than 30% in fact. What happens is, when you have current liability and long-term liability in terms of total equity is 40%, so obviously long-term debt to equity ratio should be less than 40%. So preferably it should be less than 30%. So here, instead of writing total debt minus current liabilities, you please write long-term debt divided by total equity, LTD, divided by super 6. Then the next important ratio is fixed asset to equity capital ratio. Fixed asset. How much of fixed assets you have which are invested from total equity. If this amount is the fixed asset amount is like 1 or greater than 1, means the major portion of your assets, okay, if it is equivalent to 1, means entire fixed assets are purchased from owner's money. You have full freedom in the fixed assets. But if it is less than 1, it means that some of the fixed assets are purchased using long term loans or current liabilities, which is, you cannot buy any amount of fixed assets from current liabilities. Not a good term also. It's not a good symptom. Why? Because how do you pay current liabilities when you purchase fixed assets? Fixed assets will give you some time to give you money, will take some time to give you money back. Therefore, fixed assets are to be either purchased from long-term liabilities or shareholders' equity. Preferably, this should be always funded from shareholders' equity, not to have any troubles. So if you have a ratio less than 1, it means that the amount is funded from long term liabilities, uh, fully from equity. If it is less than 1, the total amount of fixed assets are funded from equity. If it is greater than 1, it is not only from the equity but also from debt also used in acquisition of fixed assets. Okay. Okay, so here, net tangible asset to long term debt ratio. Net tangible asset to long term debt ratio, you will take only the tangible assets minus total liabilities, current liabilities and current or long term liabilities, and express in terms of long term debt. Means tangible assets, how tangible assets are purchased from long term debt. Okay, it is not an important ratio from the examination point of view, but in the real time scenario it is very much important. Why? Because from the total assets you are deducting intangible assets. Means tangible assets in the business are financed by long term debt. If it is greater than 1, it means that uh, most of the portion of these long term assets are purchased from equity amount. That's a good sign. But if it is less than 1, most of the amount is used in from long term debt to purchase the assets. Then the next ratio is total liabilities to net tangible assets ratio. Total liabilities divided by, this is just reversal of the previous ratio. Okay, very important ratio here is the times interest earned. You will have a definite question in the examination. Times interest earned ratio is also called as interest coverage ratio or interest cover ratio. As I told you that this is the only one ratio which will take some portion of your income statement in the calculation, that is EBIT. So it shows us that how much of EBIT you earn to pay interest. Let me show you an example. Say for example our company has an EBIT of say $800,000 and we have an interest cost on borrowing of say $200,000. You have an amount of taxable profit of $600, 600,000 EBT. This $600,000 is subject to tax. Okay, so tax of say 40%. Now you are paying 240, that is 40% of 600 toward tax. What you have is only 360. So bondholders and banks who gave you loan are getting $200 interest, whereas you are getting only $360. From this $360, you'll have to pay installments, pay dividend to preference shareholders, pay dividend to common shareholders, and also retain some amount in the retained earnings, which is not enough. Therefore, we should have this EBIT portion should be higher, as much as possible higher, to cover the interest, to cover the tax, and to give a good amount to the preference and common shareholders. Therefore, we need to calculate times interest earned ratio to find out whether we are earning good amount or not. If your EBIT expressed in terms of I is higher, greater, then it will be good for everyone. Why? Because EBIT is to be distributed like this: I to the bankers, I to the bankers, T to the taxes, P preference shareholders, C common shareholders, and R retained earnings. So you should enjoy the EBIT as much as higher to make all these components happier. Interest, taxes, preference shareholders, common shareholders, and some amount should be kept in retained earnings. This is what it's very important. Okay, so what you need to do is you should have always EBIT as much as possible higher to pay interest of this and pay tax of this. Then this 360 you are paying to preference shareholders and common shareholders. 360 is not enough. Just by simply giving loan to the company, banks are bondholders are getting 200,000, preference shareholders, common shareholders are getting 360. It's not enough. Therefore, most of the companies like to have a EBIT in terms of I of more than 15 times. The standard norm is 7 times, but it's not enough. Okay, 15 times mean what? You should have 15 million of EBIT if you have an interest burden of 1 million. Let me show you how it look like. Say EBIT is 15 million. Okay, and I, you are paying interest to the bonds, bank loans, etc. 1 million. EBT is 14 million. 14 million EBT. Tax, say for example at the rate of 40%, you are paying 9,600 here, 9,600,000 you are paying tax. Now what you have with you is from 5,600,000. 5 million. So you will have 8,400,000 net income. This net income will be distributed to preference shareholders, dividend, common shareholders, dividend, and retained earnings. Enough. And you compare this amount with interest, you feel that it is less paid. Okay, 1 million in front of 8.4 million is nothing. But if this is 7 million or less than that, you feel that this portion is higher and this portion is lower. So that's the reason why a minimum of 7 times should be there. This ratio is expressed in terms of times. So times, it should be greater than 7 times, but more times is more good. Then the next topic is about the leverages. Okay, leverages. In leverages, we have two leverages: financial leverage and operating leverage. Financial leverage and operating leverage. In the income statement, from sales to net income, these two leverages will have an impact. Sales to net income. Sales minus cost of goods sold, you get gross profit. Okay, gross profit. Less operating expenses, you get EBIT. Operating profit or EBIT. Up to this point, whatever the leverage you have is called operating leverage. So your operating leverage has an impact on operating profit. So operating leverage is having an impact on your EBIT or operating profit. So every company wants to maintain as much as good profit, higher profit possible. So if your operating leverage is good, your EBIT will be higher. Your EBIT will be higher either if your revenues are more or expenses are less. Expenses should be less, or revenues should be more. So how many, say for example, if I want to earn $1 of EBIT, how many dollars of sales I should make? Say $3. $3, $1. If you say that my operating leverage is too bad, then in that case you may have to sell $5. Oh my God, to get $1 of EBIT, I have to sell $5. I have to make a revenue of $5, which is tedious job for me, which means my cost of goods sold is higher, which means my operating expenses are not in my control. So this one we can find out from operating leverage. Very, very good ratio to find out the EBIT in terms of sales. And the financial leverage. Financial leverage begins here. EBIT and I. This portion, because of interest, you have a financial leverage. If the company doesn't have any loan, if the company doesn't have any interest portion, it doesn't have any financial leverage. So I is deducting your EBIT to EBT, and EBT in a taxable country is subject to tax, and you will get net income. So what I mean to say is, from EBIT to net income is a financial leverage area. From sales to EBIT is operating leverage area. In operating leverage area, what we say, for earning every $1 of EBIT, what must be my revenue? In the case of financial leverage, for earning every $1 of net income, additional net income, how much additional EBIT I should earn? So from sales to EBIT, we have a leverage called operating leverage. From EBIT to net income, we have a leverage called financial leverage. This is called financial leverage, and this is called operating leverage. Operating leverage is about your operations, how the operations are in your control, revenues are in your control, expenses are in your control. But EBIT is related to your finance cost, how much you borrowed, at what rate of interest you borrowed, whether you have a good negotiation in borrowing or not, or you have lots of interest cost or what. No, that is defined by financial leverage. A financial leverage will will have always only when there is a loan, when there is a debt, and it is calculated using a formula called change in net income divided by percentage change in EBIT. And remember, in financial leverage and operating leverage, you have two formulae based on the information given. If 2 years income statements are given, year 1, year 2, you should use this formula. Percentage change in net income. What was the net income last year? What is the net income current year? Find out the change and also find out percentage change divided by percentage change in EBIT. What was the EBIT in first year? What is the EBIT in second year? Find the change, difference amount. Difference amount divided by base year amount, first year amount, will get percentage. And this formula is to be used only when 2 years income statements are given. It's not mandatory that it has to be used even single year financial income statement is given. No. If at all a single year income statement is given, you should use this formula, EBIT divided by EBT. EBIT divided by EBT. Okay. If this ratio tells us that there is 1 or 1.2, means to get $1 of additional EBT, you should earn $1.2 of EBIT. Operating leverage is about the operations of the business, how best the operations are carried out, how efficiently the operations of the business are carried out, like cost of goods manufactured, cost of goods sold, and operating expenses. If they are in our control, our operating profit will be higher. They should be in our control. So obviously we need operating income as much as possible higher. So operating leverage tells us that how the sales, revenues, and expenses are giving us the operating income. Now let's see how operating leverage is to be calculated. Again, we should use the formulae depending upon the information given. If at all 1 year income statement given, So you should find out contribution margin divided by, using this formula, contribution margin divided by EBIT. C divided by EBIT. Contribution margin means sales minus variable cost. All the variable cost, admin, selling, distribution, purchases, factory expenses, everything, all the variable costs. So contribution margin divided by EBIT. And that is the reason why the contribution margin should be as much as possible higher to get more EBIT. To get more. So your sales should be either more or variable cost should be less. If 2 years income statements are given, what you need to do is you find out EBIT percentage change in EBIT between 2 years, last year, current year, divided by percentage change in sales. If this ratio tells us that $1.5, $1.5, it means that to earn one additional dollar of EBIT, you should make an additional sale of $1.5. If this leverage goes up, your burden goes up. If the leverage goes up, your burden goes up to make more revenues to get operating income.